Today, folks, I want to break down the tips, the tricks, things you need to understand as a beginner on how my fiance and I have been able to build up a $780,000 portfolio between stocks and real estate. We're going to break down the stepping stones or the steps required to kind of build into this level of comfort, especially in a world where inflation is high, things are very expensive. And we'll break down the stock market, we'll break down the real estate side and get into the tax advantaged accounts and so much more that you can do to benefit yourself, especially if you are a younger person. If that is a conversation you'd appreciate, hit that like button, because all of this refines first and foremost down to your income savings capability. And we all know to be frugal. We all know we should cut back on Starbucks, but more importantly, we need to build the shovel of cash that we are able to save. And the only way to do that is to aspire to making money. Forget what you love. I worked in the entertainment industry for 10 freaking years. I met my fiance when I was 25 years old. So that was about 6 years ago, as we're 31 now. But basically back then I was barely making 40 or 50 grand a year. My fiance was between jobs, and it's really nice to see how we've grown together. But I've come to realize that eventually, if you love what you're doing, you're not going to love it at some point in the future. I can promise you that. Being in the entertainment industry, coolest thing you could probably possibly do. I eventually stopped loving it, and now I'm in a job where I'm able to make 6 figures a year. And though I don't love many aspects of it, I recognize that I can put up with the stress for 5 years to put myself in an extreme place of comfort. And too often people don't want to take on the uncomfortable job to make more money, because when it comes down to it, refining that amount of money you can save is going to make or break your retirement. And taking a look at this, my favorite tool of all time, the compound calculator, I'm going to leave the link to this in the description below. This is going to gauge out how long it's going to take for you to save up your wealth. And let's presume you're starting from zero. Maybe you're able to put 500 away a month, which is usually the recommended, which I think isn't enough these days, but that's 6,000 a year. It would take you roughly 30 years at a vehicle that can grow at 10% annually, like the S&P 500, to become a millionaire. But that isn't aspiring to much these days, because where I live in Toronto, a junkie house is going to cost you around $1 million these days. So you need to work harder and aspire to more. So let's presume that you and your fiance or your wife, your spouse, your significant other, putting away $1,000 a month between you, each $500 a month. Over 30 years, that's going to get you to $2 million. That's a lot better and can cut down your path to being a millionaire by about 5 years, maybe 6 years, get you to $1 million, right? But even still, let's say you can aspire to more than that, and you're each putting away $1,000 a month, or basically $2,000 a month in total combined, taking you up to $24,000. And if you're able to even do that over 20 years at a 10% rate of return, things start to look a little juicier, right? Over 30 years, let's say you're my age, 30 years old, you're going to retire at 60. That really builds into a nice, healthy retirement, because inflation, things will continue to go up, and that 4 million isn't going to be what it is today. I can promise you that. And these numbers might be a little bit daunting at first, but I promise you, if you're younger, you can build into this. Firstly, you're going to have to be nimble. You can't do what we did anymore living in Ontario. We're fortunate to have put ourselves in this position starting really early on. But if you're starting at 20 right now and you live in these really expensive cities, Vancouver, Toronto, if you're New York, whatever, you need to leave. Honestly, forget paying for an education. I would get into trades. I would basically get paid to learn a trade, which is great. And then you can go somewhere affordable in the US or Canada, places like Alberta, where you can really utilize those skills and eventually maybe utilize the income that you've earned to buy a house, learn how to do value adds to real estate, or even put that money away and start investing it. And from the investing side of it, let's kind of talk about housing and investing, because you really need to start maxing out your tax advantaged accounts. Canada gives you this benefit to perpetuate extreme amounts of wealth if you understand how to utilize these tools. The TFSA, this tax-free savings account, is a sheltered account where you pay taxes on the money earned, you put it in here, and it perpetually makes tax-free income in perpetuity for the rest of your life. This is probably one of the best vehicles you will ever utilize to build up wealth, and it's the first thing you have to maximize. Depending on your age, the government allows certain contribution limits, and they typically increase it year over year. Right now, I think the annual amount is $6,500, and it starts, I think, when you're 18 or 19 years old. So figure out what it is by logging into the CRA website, figure out your contribution limit and max this out. Put it into really starter vehicle investments. If you're into individual stocks, I'm not going to get into that in the video, but you could really start with basic investments like VOO, VCE, broader market index funds that offer around a 10% annualized return, actually greater than that. I think VOO is sitting around 11 or 12%. You also have the registered retirement savings plan. The second account, you're probably going to want to max. Now, this account works a little bit oppositely, because basically when you put money in this account, the government says, hey, we're not going to charge you tax. We're going to give you a tax refund on any tax you paid on the money you put in this account. So it defers any tax that you made on that money into the future, and it allows you to invest it tax-free in perpetuity until you have to draw that money out by the age, I think, of 71. You have to get most of the funds out of this account, and then you pay your nominal income tax bracket rate on that money. But again, you don't have to pay taxes on it right away on that income earned like you do with a TFSA. And again, you can draw draw against it later in your life and make tax-free, tax-free gains and dividends in perpetuity for as long as it's there. Beautiful accounts. The third thing you can use now, luckily, is an FHSA account, the First Home Savings Account. This account is basically the combination of a TFSA and RRSP. It's honestly incremental at this point. I think you can put $8,000 a year into it. It works similarly that you get the tax deferred income you put in here. It makes tax-free gains and dividends, and then you can draw against it, but only for a first-time home purchase, which is something we didn't get to utilize, but it's something that if you're new to the market, you're going to want to max as well. And then finally, in the more advanced realm of things, corporate investing. Now, this isn't going to be probably applicable to most people, but what you should do is aspire to having a really good income from a job, start a side hustle between maybe you and your significant other. And if you can build that side hustle into a 100K a year income, it's worth starting up a corporation to basically diversify your liability, to protect your money, and you can invest it through the corporation with many tax benefits. As most people know, corporations spend money first and then pay taxes after at crazy reduced rates. In Canada, the first $500,000 is only taxed, I think, at like 10 to 13% or something like that. Way lower brackets than your personal income level. So it's a really neat way to start taking advantage of protecting your money in different aspects, especially from tax liabilities. That will be probably a video in and of itself sometime down the road, but let me know what you think about it in the comments section. Now, from the real estate aspect, we were very fortunate to finally be able to get into the real estate market after saving substantial amounts of money, putting about a $500,000 down payment into a condo here in the city. A bit of an older building. We're not buying new. 30-year-old buildings is probably where you want to buy. They come at a much more reduced rate, a lot more space. Amenities are nicer. Yeah, the condo fees are a bit higher, but for the comfort of living, especially if you have a work-from-home lifestyle like we do, probably the best thing you're going to do. But honestly, if you're young, I would leave these cities. They are absolutely insane. You can see some of the pricing here where, really small homes, basically 2-bed condos that aren't even like in the actual city, probably less desirable areas are selling anywhere from 700 to 800. As soon as you get in the city, like it's very hard to find prices below, 600,000 that, aren't more than 1 bed, 1 bath. But what you can do, as mentioned, I would move to Calgary, Edmonton, places where you can buy condos that are much more comfortable, full homes for $500,000 that would be much more comforted of living to allow you to perpetuate some savings. And because inevitably what's going to happen here is you need to own real estate. Unfortunately, a lot of people think they can rent for their entire lives, but then what ends up happening is you get stuck with inflation, where all of a sudden, especially in Ontario here, where rents are skyrocketing. I mean, you're going to get stuck being ripped from rent, which right now a 1 bed, 1 bath in Toronto goes for anywhere from $2,200 to $2,500 a month, and that landlord is going to continue to see the appreciation of that asset over long periods of time. So what you want to do is lock in interest rates, make your expenses controllable, which no more than 30% of your household gross income should be going to a mortgage. And if you can get to that level, you're basically going to lock in your monthly expense, and it's going to go down over time, where hopefully the asset that you own appreciates over time. Owning real estate is just about controlling your monthly expense and not being caught at the whim of inflation or caught at the whim of a landlord and making other people rich. In short spurts, period of times where you have to get ahead in your life, save money, renting is the appropriate thing. But over long periods of time, you have to aspire to home ownership, and times that's going to require leaving the current place of your living circumstance. Now, finally, again, that's going to take time. We had to max out our savings accounts, invest early on. We pulled against our TFSA and utilized some other funds to do so, but we've been able to still keep emergency funds, over $250,000 between cash and investments, and breaking down our portfolio as it stands today. And again, this purely comes from cost averaging into very good assets, and now finally focusing more on broader ETFs, but still well over 20% of our portfolio is sitting in individual stocks. But to break this down from a fundamental level, we can see that a good chunk, at this point, 30% of our funds are just sitting in VOO. And again, most people will focus on dividends over capital gains, and I think it's a mistake early on. Total returns, if you're not retiring tomorrow, matter a lot more than focusing on, I would say, just growth or just dividends. It's honestly the combination of both that these broader ETFs give you that will yield generally the best results. We try and focus on everything. As you can see in our portfolio, we have dividend stocks in Canada, we have growth stocks in the US, and then we have these broader market ETFs, because VOO's last 10-year return has been 12.4%. And if we go back to the compound calculator, I doubt out the next 10 years is going to offer those kind of returns. But historically, over a 20-year period, you would have never lost money investing in the S&P 500. But at 12%, let's say you're even putting away $1,000 a month over a 30-year period, I mean, that dramatically changes the future value of those funds. So you need to look for these stable, long-term, 30-year track record kind of investments. It's also why we put some money in the Schwab US Dividend Equity ETF, more related to the Dow dividend stocks. This one is a relatively new ETF. It's only been around for about a decade. A little bit more risk without the performance aspects of it, but at least we've got 10 years of performance where the rate of return has been about 11.6%, also much higher than average market returns, and gives you a healthy dividend that you can reinvest to get some compounded rates of return as well. On the Canadian side of the border, our third largest investment, again, SCHD being around 26.6 or 25.6%. VDY is much smaller because we liquidated those funds in a tax efficient manner to, again, purchase some real estate. I like VCE, the broad market Canadian index. VDY is a good dividend payer. These Canadian stocks have never offered the same kind of growth or returns as the US, but it's still a very healthy proponent if you're looking for somewhat dividend income. I mean, your 10-year rate of return has been about 8.33%, which again, I wouldn't make this like the hugest portion of my portfolio, but I think it could be a healthy proponent for diversification. Now, from the individual stock perspective, we still like the risk because most of our gains and returns in the market that put us in this situation came from buying individual stocks, large caps, small caps at the right times, taking profit when the stocks rallied aggressively. Meta being pretty much the top holding we have right now on an individual stock basis, only making up again about 4% of the entirety of the portfolio. Very minimal in comparison to the obviously all our investments, as we try not to take on too much risk. Second in line, Toronto Dominion Bank. I do like the Canadian banks a lot. This one has offered great long-term returns. Third in line, we have Apple. These stocks might be upper weighted because they're such large positions in VOO. So though we own maybe smaller percentages, maybe 2 to 5% between Apple, individually, like just take a look here. So if we own, say, 4% of Meta, it's a pretty large weighting in VOO. So we might actually own maybe 6 or 7% of our whole portfolio in Meta just because of how it's weighted in some of these ETFs as well. So we're just trying to pay attention to our mitigation, but our three largest individual investments is Meta, TD, and of course, Apple. Now, what I want to point out again is you really need to look at the long-term returns. A lot of people have been kind of talking about these covered call ETFs, and though I think if you're looking for purely income, they can be a proponent of one's portfolio, but they should be very mitigated because they just don't offer the long-term returns. Like here's ZWC, the BMO High Dividend Covered Call ETF with a 5-year return, not a long track record of only 4.12%. I've been looking at a ton of these ETFs. There's another one here called the BMO Covered Call Canadian Bank ETF, which I know was a favorite, but we can see the 10-year return of this has only been 7.65%, actually underperforming the Canadian High Dividend Yield ETF. Covered calls, I think, are a good proponent of income orientation in a portfolio, but you should be able to do that yourself. I mean, you're better off writing covered calls against the S&P 500 and doing it on your own than paying somebody a high management fee to underperform the market over time. And I think I can't really find one covered call ETF that has had a 10 to 20-year performance that has actually outpaced the broader indices. So that's just my opinion on it. So many people have brought it up over time. But these are kind of the stepping stones that I think people need to take into consideration. Just recapping, first and foremost, you need to focus on your income. The more you can save, the more frugal you can be, the better off your life is going to be. And I call it the 10-year prison sentence. Basically, when you hit 20 years old, you should look at your life as if I can just live as cheaply as humanly possible for 10 years, like I'm going to jail, and save over 50% of my income. When I get into my 30s, you're going to have so much opportunity. You're going to fast track your retirement. You're going to be able to buy real estate and do anything you need to do without struggling as much as many others are right now. And that's something you're seeing with us, right? We did this almost 10-year prison sentence. I started at 22, 23 years old. I'm 31, so 2 years left, still being very frugal, of course, but you can see how that evolved by putting over 50% of that income away, even for most of that time, at least 8 years. From at least 25 to 29, I was really only making 40 or 50 grand a year. Same with my fiance. We weren't making huge capital, but now over the last couple of years, I've been able to make 6 figures because I've earned and learned really high valued skills to the marketplace, which has worked to my advantage at this point in my life, which is again allowing me to spend a bit more money, but still save a high percentage of that, right? So figure out the income, get that shovel, invest in the retirement accounts. Step 2, max everything. Max your TFSA, max your RSP, do it monthly. Put as much in there as you can until the government won't let you do it anymore. Third step, right? That's when you need to start looking at real estate, putting money aside, figuring out what you can do and what markets you're comfortable in that'll work for you so you can start reducing your expenses over the long term when it comes to being affected by the rental market. And then finally, once you're able to do that, you can just really focus on fast tracking your retirement. This is where you're going to rebuild out everything that you need from the stock portfolio, work on some side hustles, build out a corporation. You can be doing that through this entire process like I've done. So at this point, me and my fiance are able to benefit from basically about 4 different streams of income. But these again are stepping stones that take a lot of work. I'm not here to brag by any metric. I'm just here to show you some of the things that we've done, talk about the experiences and just the hard work that's had to put into play to condense it down into a, what has been about 8 or 9 years into about, a 10-minute video. But I'll pass the question off to you. I'd love to know what you think in that comment section below.